This Black Friday determines if the economy lives or if it dies. And I'm not exaggerating. Wall Street analysts, economists, and the Federal Reserve are all watching this weekend's consumer spending data because it reveals the truth about America's economic health. We're talking about $1 trillion in forecasted holiday sales, consumer spending that makes up over 70% of GDP, and retail stocks that need a literal holiday miracle to survive. If consumers don't show up this Black Friday, we could be in serious trouble. Let me show you exactly what's at stake. Welcome back to StockScope Live. I'm your host, Ali, and today we're covering why Black Friday 2025 is so much more than just shopping deals. This is literally a stress test for the entire economy, and the results will impact every person in the States. Here's why this matters. Consumer spending represents approximately 70% of U.S. GDP, according to Plus 500 market analysis. This means when consumers stop spending, the economy contracts. It's that simple. Black Friday and Cyber Monday have become the ultimate litmus test for consumer health. Reports showing today that Black Friday puts focus on consumer spending for rocky markets. The Wall Street Journal said Americans are on a year-end shopping spree. But is that actually true? Yahoo Finance counters with retail stocks need unlikely holiday miracle to save rough 2025. These contradictory headlines tell you everything. Nobody knows what's going to happen, and everyone is watching. The National Retail Federation forecasts holiday retail sales will grow 3.7 to 4.2%, reaching $1.01 to $1.02 trillion. That sounds good, right? But it's actually a slowdown from previous years. And with inflation still elevated, that growth is nominal dollars might be flat or negative in real terms. We're going to break down what Black Friday data tells us about the economy and why stocks are desperate for strong numbers, which companies win versus lose, and most importantly, what this means for your investment portfolio. Before we dig in, hit the subscribe button and drop a like so you can get economic news that actually affects your money. Let's get into it. Let's start with the fundamental question. Why does Black Friday matter so much to economists and investors? Consumer spending is the engine of the U.S. economy. According to the Bureau of Economic Analysis, personal consumption expenditures represent 68 to 70% of GDP consistently. When consumers open their wallets, the economy grows. When they close them, recession follows. It's almost mechanical. Black Friday has evolved from a single day in a store chaos to weeks-long shopping event spanning online and offline channels. But it's still the psychological moment when Americans decide to whether spend big on holidays or pull back. That decision reveals consumer confidence, financial health, and economic trajectory. Here's what makes 2025 different, though. According to Reuters, stock market performance could factor into how consumers spend over the holidays, particularly those with higher incomes who are more market sensitive. We just discussed in recent videos how markets have been volatile. Nvidia earnings causing sell-offs, Bitcoin crashing, AI bubble fears. Wealthier consumers who own stocks might feel a wealth effect working in reverse. The wealth effect, as we've explained in the past, we're going to go through right now, really is simple. When your portfolio's up, you feel rich and you spend more. When it's down, you feel poor and you spend less. With markets showing cracks in November, that psychological impact could suppress holiday spending. There's also the inflation factor. While headline inflation has cooled, prices are still much higher than pre-pandemic. A basket of goods that cost $100 in 2019 now costs around $120 to $130. Consumers have adjusted to these prices, but that doesn't mean they're happy about it. According to The Street, retailers are launching record Black Friday and Cyber Monday deals, which sounds great until you realize why. Because consumers are price sensitive and won't spend without discounts. Marketplace reported on whether retailers still find Black Friday worthwhile, noting that deals have spread throughout the year, diluting the importance of the specific day. But the symbolic and psychological importance remains. Black Friday sales data gets reported widely. Analysts scrutinize the numbers, and consumer confidence either strengthens or weakens based on the narrative that emerges. Here's the investor angle. Retail stocks have had a rough 2025. If you look at Yahoo Finance, their report shows that the holiday miracle is needed to save these stocks in 2025. Target crashed after disappointing earnings. Walmart performed better but still faces challenges. And department stores and specifically retailers are struggling. These companies are banking on Q4 holiday sales to make their entire year. If Black Friday disappoints, retail stocks could see another 10 to 20% decline. That might create sector rotation out of consumer discretionary into other areas. Conversely, if consumers show up and spend big, retail stocks could rally 15 to 20% by year end. And market sentiment would improve across the entire board. The Fed is also watching. Consumer spending data feeds into their economic models. Strong spending might make them less likely to cut rates in December, thinking the economy's fine. Weak spending will likely accelerate rate cuts as the Fed tries to stimulate the economy. Either outcome impacts every asset class. Now let's dig into some of the details of why there's now a break in the consumer stocks. There's a shocking divergence between Walmart and Target because it reveals something crucial about the consumer economy. Walmart reported strong Q3 earnings in November. Same-store sales grew, they raised guidance, and the stock jumped. According to Investopedia, Walmart jumps on strong results outlook, while the broader markets were struggling. Now, on the other hand, Target got absolutely crushed. Yahoo Finance reported Target shares experienced the worst week since April after its earnings showed the retailer cut prices at the expense of profits. Target customers' base is pulling back on discretionary purchases, forcing Target to discount heavily, which destroys margins. So what's the difference, and why is Walmart winning while Target's struggling? The answer is customer demographics. Walmart customers' base skews lower to middle income. These consumers have to shop. They need groceries, essentials, and basics. Even in tough economic times, you still need food, toiletries, household supplies. Walmart's business is more resilient because it's necessity-based. Now, Target, on the other hand, their customer base skews slightly higher income and more discretionary. Target's shoppers buy home decor, trendy clothing, electronics, non-essential items. So when budgets tighten, those purchases get cut first. Target's merchandising is aspirational. Walmart's is practical. In uncertain economic times, practical always wins. This divergence tells us something important about Black Friday's dynamic. Because lower income consumers are still spending, but only on necessities and deep discounts. Higher income consumers are pulling back either due to stock market wealth effects or general caution. According to Wall Street Journal's article, there is spending happening, but the composition matters. If spending is concentrated in essentials and deep in discount items, that's not healthy for the broader retail sector or the economy. It suggests that consumers are financially stressed. They're not confident. The gross margin squeeze is another warning sign. When retailers have to discount 30 to 40% or 50% to move merchandise, they're not making even if sales volume is high. Yahoo Finance noted Target cut prices at the expense of profits, and that's unsustainable. Companies can't survive by losing money on every sale and making it up in volume. Looking ahead to Black Friday specifically, the question is, will consumers splurge on discretionary items or will they hunt for deals in necessities? If it's the latter, Walmart and Dollar Store wins. But the broader retail sector economy are in trouble. The only exception here is Amazon. It's a wild card. Amazon Black Friday performance will be closely watched. According to various reports, Amazon is offering record deals across categories. If Amazon crushes it, that's good for Amazon shareholders, but might be bad for brick-and-mortar retailers who lose market share. The shift from in-store to online also matters. The Street noted that Black Friday has shifted from in-person chaos to weeks-long online sales. Lower foot traffic to physical stores hurts mall-based retailers, commercial real estate, and creates a structural shift that some companies can't survive. One more thing, inventory levels is going to be very closely watched. Because retailers ordered merchandise months ago based on optimism forecasts and to get in before some of the tariffs hit. If Black Friday disappoints, they'll be stuck with excess inventory heading into Q1 next year, forcing further discounting and margin compression. And that's a death spiral for weak retailers. Black Friday's impact extends far beyond retail stocks. So let's connect the dots to the broader economy and your portfolio. First, we have employment. Retail is one of the largest employment sectors in America. According to the BLS, retail trade employs about 16 million Americans. If holiday sales disappoint and retailers cut costs, that means layoffs in Q1 next year. More unemployment means less consumer spending and creating that negative feedback loop. We already saw warning signs. Business Insider mentioned that the deepest October job cut in 22 years rattled investors. If retail adds to that weakness, the labor market could deteriorate quickly. The Fed is already concerned about employment softening, which is why rate cuts are back on the table. Number two, the GDP growth. While we said consumer spending is 70% of GDP, holiday shopping is a massive portion of Q4 consumer spending. If the National Retail Federation forecast of 3.7 to 4.2 growth comes in light, Q4 GDP growth will disappoint. That could tip the economy into contraction if other sectors are also weak. Third, there's the inflation dynamics. If consumers only buy when items are heavily discounted, that means is this disinflationary, which sounds good, right? Lower prices, but that's not really true. Disinflation can turn into deflation, which is actually worse. Deflation means prices are falling, which sounds great to consumers, but it's terrible for the economy. Because businesses can't make profits when prices fall, leading to layoffs and economic contraction. On the flip side, if Black Friday sees strong demand, retailers might be able to maintain pricing power. That keeps inflation slightly elevated, which the Fed is trying to avoid, but it's a delicate balance that we need to maintain. Number four, this is probably one of the worst ones, is credit card debt. Consumer financial health is a big problem right now. According to the Federal Reserve data, credit card debt has hit a record high in 2025. Many consumers are financing their spending with borrowed money. If Black Friday spending is strong, but it's all on credit cards, that's a ticking time bomb. When those bills come due in January and February, consumer spending could collapse. Plus 500's market analysis noted that traders monitor Black Friday because consumer spending comprises approximately 7% of the GDP, making retail sales data a valuable economic indicator. Institutional investors and hedge funds are literally watching Black Friday data to inform their market positioning. Here's a scenario. Bullish scenario. Black Friday exceeds expectations. Sales growth comes in at 5 to 6%. Consumer shows confidence. Retail stocks rally. Market sentiment improves. The Fed feels comfortable cutting rates because the economy is strong enough. The S&P rallies into year-end. Santa Claus rally materializes. Bear scenario. Black Friday disappoints. Sales growth is flat or negative. Discounting destroys margins. Retail stocks crash. Consumer confidence falls. Unemployment fears rise. The Fed cuts rates aggressively out of concern, but markets interpret that as panic. S&P sells off. Into year-end, recession fears intensify. There's a neutral scenario. Black Friday is okay. It's not great. It's not terrible. Sales growth maybe 3%, 2%. Mixed results across retailers. Market stays choppy and uncertain. No clear directional signal, and volatility continues. In my opinion, the best we can hope for is the neutral scenario. Obviously, we wish the best, but let's be real. Honestly, the data is pretty mixed. So some indicators suggest consumers are tapped out. Others suggest they're willing to spend but cautious. The truth will come this coming weekend and into Cyber Monday, and we'll find out. All right, let's get practical. How should you position your portfolio around Black Friday and holiday retail data? Strategy 1 is don't overreact to headline numbers, because Black Friday sales figures will be splashed across the media, but initial reports are often inaccurate. Online sales gets revised. In-store estimates are imprecise. Wait for the full data from MasterCard, Spending Pulse, and other reliable sources before making major portfolio moves. Number 2, watch specific company performance, not just aggregate numbers. If Amazon crushes it, but Target and Macy's disappoint, that tells you the shift to online is accelerating. Position accordingly, long Amazon, short or avoid legacy retailers. Strategy 3, consider the consumer staples versus consumer discretionary trade. Because consumer staples like Walmart, Costco, Procter & Gamble are defensive and perform well when consumers are cautious. Consumer discretionary like Target, Nike, luxury brands are cyclical, and perform well when consumers are confident. Black Friday data will tell you which came to favor. Strategy 4, don't ignore the international angle. U.S. Black Friday affects global markets, European retailers, Chinese manufacturers, international logistics companies. They're all going to be impacted. If U.S. consumer spending is strong, emerging markets are going to export and benefit from it. Number 5, bond markets. If consumer spending is weak, expect the bond yields to fall as recession fears rise. Long-duration treasury bonds could rally. Conversely, strong spending might push yields higher. Adjust your fixed income allocation accordingly. For active traders, there's potential volatility plays. According to market analysts' commentary, some institutional investors are using this period to reposition. They're reducing exposure to highly leveraged retailers, increasing positions in discount retail and e-commerce, and hedging consumer discretionary exposure with puts or inverse ETFs. Now, one contrarian idea is if retail stocks have already priced in disaster and Black Friday is just mediocre, that could be enough to trigger a relief rally. Sometimes bad news that's not as bad as feared is actually good news. Target is already down significantly. If their Black Friday isn't catastrophic, the stock might actually rebound. But be careful with falling knives. Just because a stock is down 30% doesn't make it cheap if business is deteriorating. Now, long-term investors should focus on quality. Companies with strong balance sheets, pricing power, omni-channel capabilities, both online and in-store, and loyal customers will survive and thrive regardless of short-term Black Friday results. Amazon, Walmart, Costco. These are fortresses. Struggling mall retailers with debt and outdated business models, those are traps. Remember, economics isn't just abstract data. These are real people making real decisions about how to spend their hard-earned money. Black Friday reveals the truth about consumer confidence, financial health, and economic direction in a way that government statistics sometimes miss. Whether you're a shopper or an investor, this weekend matters. Pay attention to the signals. Watch what companies do well and which struggle. Use that information to make smarter investment decisions going forward. If this helped you in any way, make sure you smash the like button and subscribe to this channel. And hit the notification bell so you don't miss updates like this again. Until next time, stay diversified, stay safe, and I'll catch you in the next video.